really, really wanted to pick it up easy, and still it requires some work ethic and effort, and first learning the language. So you can see right away, like by me having all these things on my chart, which is what you're not used to seeing me do, you have to see the dynamic around how the market's operating in them. Otherwise, you're not going to fully appreciate it. And when you're looking at your charts and you're back testing, like I said, I prefer to see this inefficiency support price. I like the fact that we haven't broke down yet, but if it does, and the midpoint of this down close candle sets the stage for a run below that, um, I'm looking at these highs here as they're trying to trust or build in trust that anyone that's short, they're going to want to drop their stop loss down here. And if that happens to be the case, they may take out that low or this low and then run for that area, because it'll give them reasons to buy below this low. If they take it below that low, they can buy that and then start distributing those longs here, then here, and work inside all this range back up to new day opening gap. And what I just did there is probably like, how did you get to that? That's experience, but you don't need that. Not in the beginning, because you don't have any to work with, Caleb. You have to get this every single day by being in the charts. You just want the obvious, easy setups, the ones you can see clearly. If it's not obvious, you can't be mad about it when you missed it. And as you do this more and more for everyone else, that's a order block right there. So since we tapped it, it needs to start delivering above here. Any failure to go lower sets the stage for a run lower into that, and then we could probably just keep dipping lower into it, into a lower daily range. I'll just say, oh yeah, the most obvious runs where the market is clearly in the first 30 minutes, you have a lot of advantage knowing where, if there's a large range gap, that halfway point of that gap is such an easy, just, man, that's like, it's an obvious thing. It's obvious. It doesn't mean you're going to be right every single time trying to trade for it, but if that's where you're going to start with as your foundation, it's going to serve you very, very well. And in this case, you saw that we had the buy side. It went to that lower quadrant, it went to that, and it just fell short of opening range gap consequent encouragement, which is still here. So what I'm looking at is I'm seeing how we left those smooth highs. Mid gap is still up here, hasn't been traded to. We had a really nice short-term low that was priced in quickly. We folded, went lower, took that low out here, failed to go lower there, but we're building this little clean area. This candlestick is to trigger whether or not we see it go higher or not. If it's going to go higher, I don't care about all the mess around here, and I can trade above this area if I want to go long to get this smooth high and consequent encouragement mid gap. If I'm aiming for that, if I'm bullish, that's what I'm aiming for. I don't have anything to do yet. I'm trying to stay with you long enough today to do something. I don't want to close the stream and not have pressed the button. That's what I'm doing. If I would have traded by now and took a trade and showed you where stop would be, where I'd look for it to run to, I would already close the stream out. But if it rolls through this consequent, or I'm sorry, mean threshold, this down close candle, that's this. If it's bullish, it shouldn't trade and go below on a closing basis. No candlestick should close below this mean threshold. It can stab through it. It can theoretically stab all the way down and match the same candlestick's low. It's bad. It's not the best for something like that to happen, but in theory, it can do that. Ideally, the upper half should keep price at bay and not go lower if it's bullish. But if it can keep going down and touch that midpoint, that's indicating that it's not something good. Now, what you're saying is what happens if you're buying that? I'm not trying to buy an order block today. I'm trying to trade the fair value gap, but I'm giving the logic around price action until a fair value gap forms that I would be willing to take. See, that violates it. And look how fast it accelerated through the bottom of it. What you're looking at is how I'm taking an order block to frame a displacement higher or lower in that next price run. Then I have to reassess and see what is it reaching for now that it's done this. Expecting it to fail, that's part of using the PD arrays, because it gives you sit still or go the other direction. In other words, it gives you the rhyme or reason, where most traders, most mentors out there that are out there trying to teach, they don't know what they're doing. They're reacting to price, they're chasing price, they're momentum breakout artists. That's not me. All right, so now we have the potential of this little fair value gap right in here. It's not there yet, but as long as we don't take out that low right in here, we might have something to work with. It might not end up becoming an immediate rebalance. Immediate rebalance is coming right back to this candlestick's low. If it touches that, then the very next candle or that candle, usually we'll see it run in the same direction it was moving prior. Yeah, not much of a gap now. Yeah, I'd consider that immediate rebalance. I'm watching the wick in here. If it can stay in the lower half of it and not trade it above it or an upper half without taking out that high, it should roll right over and attack that low here. So if you were looking at this candlestick like I was outlining it, if it was going to be bullish, the upper half of that to the midpoint should be doing what with price? Supporting it. If it trades to its middle point, which is the mean threshold, it indicates it's weak. So now what happens when you start trading up into that same range here?